Hello and welcome to today's webinar, In-House Bank at the Estee Lauder Companies, a Case Study. Thank you for holding. My name is Christine Monk and I'm on the marketing team here at Serrala, and I'll be moderating today's webinar. Please note the disclaimer on the first slide here. And then I'm going to give you a few housekeeping tips before we get started. Today's webinar will be approximately 45 minutes, followed by a question and answer session with our speakers. Using the console, you can adjust the size, of the slides and of the video to accommodate a better view for you. You can submit your questions to our speakers using the question and answer box in the bottom of your console menu. And finally, the presentation will be recorded, and everyone who's registered or attends today will receive a link to the recording after the event by email. And now I'm very pleased to introduce you to today's webinar speakers. Bart Tijmans, Executive Director of the Estee Lauder Companies. He is based in Belgium. Bart is responsible for managing global treasury operations and heading the International Treasury Center. He joined Estee Lauder in 2007. Prior to joining Estee Lauder, he held several positions within the Treasury departments at Siemens. And Bart has worked extensively with my colleague, Peter Wolf, who's our Senior Vice President of Finance and Treasury Solutions. Peter has specialized in SAP Treasury Solutions for over 20 years. His experience and expertise span the entire suite of SAP's Treasury, cash management, and electronic banking applications. And now I'll very happily hand it over to Peter, who will introduce you a bit to Serrala.
Great. Thank you very much, Christine. Welcome, everyone. We are very excited about the topic today and excited to have Bart here to give us insight into Estee Lauder's experiences. So I really want to jump right in so we can get to the content. So first, from the perspective of agenda, we will do a short introduction to Serrala, and then we'll get into the meat of the webinar, which is Estee Lauder Companies Overview, then Treasury Solution Landscape, and we have a pre-project landscape, post-project landscape. We'll then focus heavily on the in-house banking portion of the functionality that they have deployed and their solution. And then we will get into the key in-house bank processes, and ultimately Bart will give insight into the benefits that they have been able to recognize by deploying these solutions at Estee Lauder globally. And finally, we'll wrap up with question and answer, where hopefully we'll be able to answer some of your questions. So, Serrala, an introduction. For most of the people that are on, most of the attendees today are familiar with us already, so I will keep this brief. But ultimately, Serrala is the leading software and solution provider, services provider for the universe of payments. And when we say universe of payments, we mean that in a very broad context. We're talking about all aspects of payment management, inbound and outbound payments, upstream and downstream, from order to cash and procure to pay, all the document and data management associated with that, treasury for the risk and exposures, and the liquidity management associated with the cash for the payments. And ultimately, we are the leading implementers of solutions and provide the broadest solution set in this space. We have about 2,500 plus customers, over 700 employees focused on this area of expertise, over 30 years of experience, and 16 offices around the world. So more specifically to the topic for today is our experience in the treasury space. We have been focused on SAP Treasury since the 90s, so over 20 years. Partnering with SAP and helping them to expand and deploy and enhance the solution that they deliver in the treasury space. We have over 400 projects globally, hundreds more projects of spot support, supplemental system analysis, etc. We are the largest team, have the largest team of SAP Treasury specialists in the marketplace, and experience across all regions, pretty much all countries, regions, industries, etc., delivering solutions around the globe. We are the first implementers. We're the first implementers of SAP's new S/4HANA Treasury in North America, which we're certainly very excited about, the new functionality and deploying that and working with clients to fully recognize that functionality. And we are a certified service and software provider for SAP, as I mentioned. So we provide supplemental tools that add to the functionality, capability, controls, flexibility, usability of the solution. So getting into the meat of the presentation, I'd like to turn it over now to Bart to discuss the Estee Lauder companies and provide an overview. Bart?
Yeah. Okay. Well, thank you, Peter, and hi everyone, and welcome. Before I'm going to dive in and give you more of details, if you will, on the in-house bank solution that we deploy at the Estee Lauder companies, I'm just going to give a brief introduction about our company. Estee Lauder was founded in 1946 by Mrs. Estee Lauder, whom you see pictured here on the slide. And Estee Lauder is one of the world's leading manufacturers of skincare, makeup, fragrance, and hair care products. Sales amounted to well above $14 billion as per fiscal 20, and products are sold globally in more than 150 countries under a number of well-known brand names. As per June 30th, which is the end of our fiscal year, we had approximately 48,000 employees worldwide. Here you see on this next slide some of the brand names which are categorized under, for example, heritage brands like Estee Lauder, Clinique, and Origins. We have our makeup artist brands like MAC and Bobbi Brown, luxury brands like La Mer, Jo Malone, and Tom Ford, and then other designer fragrances, as we call them, which are sold, for example, under Tommy Hilfiger, Donna Karan New York, which we license from their respective owners. So then let me give you a brief overview of how we, as a treasury organization within Estee Lauder, are structured. So headed by the group treasurer. Within the treasury organization, we cover, next to what we call core treasury activities, also enterprise risk and insurance management and global real estate. I'll obviously not dive into those today, but obviously we'll focus on the core treasury activities under which treasury operations falls. So core operations or cash and treasury operations is run really out of two centers, one based in the US, in New York, and one based in and named the International Treasury Centers. So under cash management, we really mean, let's say, the concentration and investment of global cash. That's really what we do. Treasury operations also includes back office and accounting and control activities from that perspective. So how we are structured then in Melville or the US, we concentrate cash and manage all cash requirements for essentially all of our US entities and the brands. And in Belgium, we manage global cash management activities through, let's say, the in-house bank structure, obviously, where cash-rich affiliates deposit excess cash with the International Treasury Center. And we provide cash to entities that need borrowings, if you will. Under certain conditions, affiliates are also allowed to borrow externally, but that's more on an exceptional basis, and most often that's to comply with certain local rules and regulations, if you will. Back office activities, like, for example, deal confirmations and settlements, are handled in both treasury centers, allowing for both of time zone settlements, if you will. And so we do try to achieve economies of scale across both centers, whereby, for example, on the US side, they have the responsibility for managing the global bank account administration, which is approximately 500 plus bank accounts globally. So they handle the opening, closing, and any signature changes that are required. And they also administer what we call the global treasury policies. The ITC, on the other hand, has been designated as the accounting center of excellence, where monthly accounting activity, amongst which including close of books, is centralized. So then going to the next slide, really. Now, before I go into the, hold me.
I think that was me, yeah. Bart. I didn't see you progressed it, so I pushed it ahead. Sorry about that.
Okay, all right. Sorry for that. So this slide really is taking maybe a little bit a step back in time, going to around 2016, I think, where we had developed, let's say, the plan on integrating more of our treasury processes into SAP. And basically that's driven by our overall finance mission, if you will, whereby we want to, as a treasury team, create incremental value for the company and the shareholders. And as you can read it from the slide deck, creating more efficient processes, analytical excellence, strategic and insightful thought leadership, what have you. I mean, these are things that probably resonate to many companies, which will find, or where we will find similar mission statements. So no different on our side, really. From a treasury perspective, we are centralized as such. As I indicated on the previous slides, we have our US operations and Belgium operations. In country, really, we do not have any employees, let's say, who are part from our treasury organization. As such, we are supported by the local finance teams, but those do not necessarily operate, obviously, strictly treasury activities, but more of a generic finance activities for the subsidiaries. For us at that time, again, it meant to look to standardize, integrate more of the treasury processes into SAP. The reason for that is that because our company had completed a multi-year implementation of SAP across all entities globally, whereby all entities really are now on SAP, on one instance of SAP. Obviously, that's a big win, if you will, or a big driver for us from a treasury perspective to look and leverage the technologies available within the system, let's say, and making treasury actions more efficient throughout the organization. So let me then give you an overview of the treasury landscape. This is pre-project. So this slide is meant to be a bit of an overview where how our treasury landscape looked at prior to us engaging in this project. So what we overall could say is that we had a suboptimal and fragmented treasury system infrastructure. We were using a treasury management system at the time for managing FX debt. It did also include an in-house bank solution at the time. We did have that treasury management system interfacing to multiple ERP systems. This is again pre-SAP implementation for us in Belgium. So we interface to a different ERP system in Belgium and to SAP in the US. And a second main aspect that we were looking or bumping in against, if you will, pre-project was an inefficient banking landscape. Meaning that we had multiple, what we call non-relationship banks and a large number of bank accounts, particularly in EMEA. We were talking about 35 plus different banks we were operating with. And that was really a project that we entered into prior, actually, the in-house bank implementation. And I'll get to that later because it made it obviously more efficient later down the road, if you will, to more centralized towards working with fewer banks versus the 35 plus different banks in EMEA. So that's the background of that. The way that looked from a more of a graphical perspective, if you can say so, is on this slide. So on the left-hand side here, you can see that we operate our FX and execute that in a different platform. We are using, for example, FXall from our perspective. And also from a cash flow perspective, we're getting the information from various subsidiaries in a different standalone system. But those two interface really into our Treasury workstation in use at the time, as I said, covering FX and capital markets, where we also managed our cash, and where we had a functioning in-house bank really at that moment in time, from an international perspective. Then in that middle block, you can see two SAP systems highlighted. Within the middle, an intercompany netting system. That was an outside third-party netting system which we had in use, which meant that we had to interface to and from that netting system data really from our SAP systems. And we're making that two different SAP systems because on the one hand side, that accounts for us as a treasury entity, and on the other side, we have our affiliate entities. There are different flows really that we then needed to interface from the Treasury workstation to the affiliates, and really from the affiliates to us as a Treasury center from a factoring perspective. Again, this picture is really meant to state that there's a lot of back and forth between different types of systems, making it obviously less efficient. Even if we move to the right-hand side of this schematic, if you will, on the top side, you can see that from a Treasury workstation, we were leveraging SWIFT, using a SWIFT service bureau at the time for routing our high-value Treasury payments to the banks. But on the other side, for our accounts payable, using various EBS systems and bank portals to connect with the bank. So very disparate systems used across the company. So again, so the objective was one, what I talked to earlier on in the presentation already, to create a pan-European platform to more efficiently centralize excess cash, meaning that we had to harmonize across banks. And also that we needed to, and these are obviously words that also resonate to probably many of you, simplify, centralize, automate, and integrate where possible some of the Treasury processes. So key focus was really on eliminating many of those manual steps, fewer interfaces. As I said, you saw the many connecting arrows that we had on the schematic on the prior page. We wanted to focus on working with core banks, harmonize payment formats, so that we can really make it more efficient from a payment perspective, and increasing the control and cash visibility that we have throughout the company. So then maybe just on an overall perspective, this slide is a bit sets the standards really. We're talking about in-house bank, we're talking about in-house cash. I mean, at least on our end, we're using both terminologies wherever we need. But basically, the in-house bank is that's more meant to be the solution from having a virtual internal corporate bank, if you will. Whereas in-house cash is really referring to the solution and the name that SAP is using for its application in managing and running the in-house bank. So we all know, so such in-house banks are primarily implemented by multinational companies, I would say, with multiple subsidiaries, no different than at Estee Lauder. And the benefits are having an increased control and a more global view of your liquidity position, obviously automating the process, making it more efficient and standardized. The basic fact is obviously that we do not need to route all of these type of settlements via banks, but can settle those virtually through in-house bank accounts. So we'll get to more of that detail later down in the presentation. So then we come actually at the functional summary of our project scope. So basically, what we want to set up is an in-house bank. What that meant for us was the creation of 3 in-house banks. We'll get to the reasoning why later down. But 3 in-house banks for us at an Estee Lauder perspective. We needed to transition, let's say, a netting process using an external netting system to using the SAP in-house cash netting. And retire the legacy netting system as such. And that was obviously one of the key goals. As I said, we had a netting system, but only an international netting system. We did not have a US netting system. That was also one of the project scopes, creating a US netting process. Making matching and clearing of U.S. intercompany positions much more efficient. Payments on behalf, receive on behalf needed to be part of the solution. So we at the ITC are running a POBO process whereby we execute foreign currency payments on behalf of our manufacturing plants. We also collect on behalf of the U.S. Treasury Center from a Treasury settlement perspective. What it also included in the project scope was connecting to SWIFT, enabling, let's say, what's called a bank communication manager, and doing away, let's say, with an external SWIFT service bureau. Having that connection more or less in-house. Again, we opted for a semi-approach using the Alliance Remote Gateway, but having that connectivity straight away embedded from within SAP was a key goal. From a payment processing perspective, we looked to enable, let's say, processing our payments directly from within SAP through SWIFT, STP, and so a straight-through process. So eliminating, where possible, those electronic bank systems or bank portals. It also meant that we had to have a view on our cash position in SAP, so a full cash positioning for 100 bank accounts, and cash visibility for many more bank accounts, for which we don't have a full cash positioning need, but have a need to understand the bank balance on those accounts. That also allowed for, certainly for those 100 accounts, for the main accounts, if you will, where we have the most of our activities, to have intraday polling, so that we can have an update intraday for a change in balances where applicable. Last but not least, electronic bank statements, an obvious one, but enable automatic electronic bank statement processing for all these accounts was a key functional scope. And also bank account management, whereas we were managing that externally, pulling that into SAP from a bank repository perspective and signature database perspective. That's also one of the project scopes that we have. And then I think I'll hand it over to you, Peter.
Great, thanks, Bart. Terrific baseline there to understand where you were as an organization coming into this. I think that's very helpful as we look at what the solution that ultimately was deployed and how you addressed many of those topics. So when we look at this slide here, what we're looking at, it's a lot of information here, but fundamentally what we're looking at is a summary of SAP's Treasury applications. Now this says S4HANA on the slide, but this is the same for ECC, SAP's core current solution, not their newer S4HANA. So the applications remain the same from this overview. But with Estee Lauder, they did not need the full scope of functionality here. What they ultimately needed to implement was a subset. So you see here the highlighted subset sections that were included in the scope for delivery. We had the cash management applications, so managing of cash position and short-term liquidity, visibility, and in-house cash, in-house banking. Again, as Bart identified to you, in-house banking being an industry terminology, meaning more that structure that you have external to systematic or independent of a system. And the in-house cash is SAP's application name for their in-house banking solution. So within that area, the in-house banking solution, there are really 4 subcomponents with the actually, this says Robo. It's really POBO that was in scope, cash pooling, intercompany loans, and intercompany netting. And then the SAP Bank Communication Management. Additionally, there were some areas where the needs, Estee Lauder's business requirements and needs were not met by standard SAP functionality, and we, Serrala, were able to provide supplemental add-on programs that enhanced the solution in different areas and supplemented with user functionality, additional controls, reporting, processing efficiencies. SAP is very adept at providing openings for you to deliver customized functionality or unique functionality to supplement or to fill in where there may be functional gaps. And so we were able to satisfy a lot of areas where Estee Lauder was looking for a little bit something more in the cash management space with dealing and setting of their cash position, and in the payments, especially with the integration for bank statements and payments. We provided a number of add-on solutions that help to increase the efficiency. As I think Bart will talk to a little bit later, one of the challenges is with dealing with all of the payment file formats that we needed to deal with. And so our payment medium workbench control framework provides additional supplemental functionality there that help to create substantial efficiencies in that area. In the in-house bank, again, supplemental functionality for payment processing, tracing, reporting, and reversal, which is an area that can be very challenging, and other areas as well. And then bank account management, as Bart mentioned, bank account management was a scope, a functional scope for this project. But in ECC, SAP does not provide a comprehensive bank account management solution. So we had actually developed a solution at SAP's request about a decade ago, and we continue to be the only provider that I'm aware of that has a solution embedded into SAP's ECC for comprehensive bank account management, signatory database, and fee analysis. In S4HANA, SAP does actually have a new solution where they do cover this area, but in ECC, there is a supplemental add-on required to be able to fill that void. And then Autobank. Autobank is really for cash application and reconciliation automation, and this was an add-on solution after the implementation project we did, where Estee Lauder continued to refine their solution and enhance their efficiency in processing. And this is with the payment service provider, Adyen, that they utilized. This helped to substantially reduce manual reconciliation that was having to take place. So this is really the technical scope of the implementation that was done. When we look at this in more of a kind of a landscape view, you see that Estee Lauder continued to have their Treasury workstation, Reval, as a standalone workstation, but with integration into SAP. So the integration allowed for integration of deal processing, the results of the deal processing, into the SAP Treasury space to allow for visibility for cash and liquidity, for processing and execution, and straight through processing, as you see in the center here, through to the SWIFT access, through the SWIFT gateway. And as Bart had said, there was a direct integration between Treasury and the SWIFT solution, but through a service provider, service bureau previously. Now they have a direct integration through SWIFT Alliance Access or SWIFT remote gateway. And that allows for them to deliver the payment files as well as receive payment acknowledgments and bank statements through their integration with SWIFT out through the SWIFT net, and then to deal with the banks, which obviously facilitate execution of the payments and or receipts processing and providing of acknowledgments of the status of those payments. So within the Treasury space, again, we mentioned that the focus was on cash and liquidity, in-house banking, bank communication management, bank account management. So those are the four key components. And they're all fully integrated with one another and with the core SAP finance application. So the general ledger, accounts payable, accounts receivable. So all of the accounting is fully automated. And Bart had talked to this, the efficiencies that are gained from integrating and utilizing the in-house bank solution to really be able to optimize the automation processing at all levels of the process, including the execution and clearing of the invoices, but also full accounting, etc. So those are certainly substantial benefits, that full integration that they're able to recognize. Bart, is there anything else really on this area that you'd like to add?
No, I think, I mean, you mentioned the key takeaways here, Peter. I think, most important thing to highlight here, from an overall perspective, is that there are less arrows. Huh? That's the main point, right. For us. And the key takeaway, really, I wanna give here, that we have obviously the Treasury management system as a top layer tool for us to manage foreign exchange and debt. And there's obviously an interface, yes, that is that arrow. But the SAP bundle, that's one integrated tool. So the arrows below, from a cash liquidity management, in-house banking, to finance, to the GL, accounts payable, receivable, that's one and the same system. It's not a matter of interfacing between it. That's a big win, having everything in one and the same tool. That's obviously very efficient for us. And again, not the least on the right-hand side, deploying then that connectivity through leveraging, let's say, BCM in connecting with the banks is also proven to be very beneficial, obviously. Yeah.
Great. Okay, so then next we'll talk about the in-house bank structure. And Bart, if you could cover this slide here on the in-house banking overall solution.
Yeah, sure. So, yeah, what this does is this slide really provides an overview of the in-house bank as it is set up within our group. So, as highlighted before, that consists of 3 bank areas. You can see those on the slide here with the dashed lines, if you will. So we have the in-house bank center 1. Which is the U.S. entity, ELI. Then we have a second in-house bank center, also based in the U.S., ELII named. And then we have the third in-house bank center, which is the International Treasury Center. So the a bank area, maybe start there. That's really an overlaying entity, or a main organizational unit, as you can say. I always also like to make the the comparison with a bank, for example. A bank will also have a branch, let's say in New York, or a branch in London. The same way you can see this from an in-house bank perspective. In this case, we have 3 different branches. But there obviously can be as many or as little as needed, depending on the organizational structure from your company. Each bank area on our side is managed by a separate legal entity, or company code, as we call them. And again, 2 based in the US. Why that really? I mean, the one on the left-hand side, ELI, is mainly focused, is solely focused on managing the intercompany relationships with US domiciled entities. The ELII entity, on the other hand, one of the I stands for international. That's a US entity which also holds relationships with non-US based entities. So therefore we opted to make a separate one out of that. And then obviously the International Treasury Center is managing the relationships with all entities globally outside of the US. And that was an existing in-house bank area, but obviously now going onto SAP. So all in-house bank activities recorded by these legal entities are reflected on the GL, if you will, of that respective legal entity. So that will trigger accounting entries in the GL maintained by the in-house bank owner, but as well as the in-house bank participants. So that's an important factor, and that will all be pushed through in SAP FI. And then, to complement on that, you can also have transfers between the in-house banks. We do that through what we call cross-bank accounts, but that's mainly to settle flows between the different in-house bank areas as such. I think that's the overall. Yeah, the overall picture.
Yeah, I think
I'm not sure if there's.
No, I agree. If we look here to this next slide, this is really the more from the technical perspective. As you mentioned, there are 3 bank areas similar to bank branches. In SAP, we call them bank areas, but they are reflected as organizational units. Those units have relationships with each other. So the affiliates, which you see in the yellow ovals at the bottom, participate in a given bank area, and that bank area has external banking relationships that it can process on behalf of those affiliates, but it also can process with the other bank areas. But the affiliates have the relationship through those header bank areas. And they're in multiple currencies, and then in Estee Lauder's case, they're concentrated to single currency relationship, but can be processed in multiple currencies. And as you can see here, and I think Bart mentioned, the Estee Lauder Inc. U.S. entity, which has the largest participation of U.S. Entities, doesn't really have a direct relationship with the ITC. It has a relationship through Inc. International, and so that is the way the processing takes place. They don't actually process directly from ITC to Estee Lauder Inc. So I think this structure is designed and developed to facilitate and support the external in-house banking structure that Estee Lauder wanted to achieve. So when we look at the underlying of this, how is this done? Well, we have these virtual banks, these virtual bank branches, and the affiliated companies hold virtual bank accounts called current accounts at their virtual bank branch. And so they hold an account just like they would at a banking institution. As we said, this is very much a banking solution, but moved to an internal corporate environment. So every entity holds at least one account. They may hold multiple accounts. They may hold multiple currency accounts, but they hold at least one account. Typically, their primary account is held in their functional currency. And then if they have large volume or unique processing needs, they may hold supplemental current accounts in other currencies or in the same currency within the in-house bank structure. And those balances in those current accounts are a reflection or represent the intercompany balances between the affiliate and the in-house bank on any given day from all the activity that's processed there. Now, the accounts are aligned with or assigned to a product type. That product type is like a bank product. If you went to the bank and you get a retirement account, or you get a savings account, or you get an interest-bearing account or a checking account, just like that in the in-house cash solution, there are products that we define. Those products then control the types of activity that the entities are allowed to do and control how we want to manage them. So, for example, we have standard accounts where a participant will fully participate and engage in the solution, can process all kinds of activity, and then we have gross in, gross out accounts where the participants fully participate, but they have to keep their accounts payable and accounts receivable, inbound and outbound processes and balances separate. So in a standard account, they can fully net their balances and they can even book settle. In a gross in, gross out account, we have to separate AP from AR, and they can aggregate settle their AP, they can aggregate settle their AR, but they can't net them against each other. So we have a number of different products that control whether they can net, whether they can hold balances, whether they have to settle, whether they get an electronic bank statement or a paper bank statement, depending on if they're managed in SAP. Bart had mentioned that most of their companies are on the single SAP platform, but there are some entities, and especially with acquisitions, entities are brought into their environment, aren't on SAP. They can be brought into the in-house cash solution, even though they're not managed on SAP from a FI general ledger. And that's pretty important for companies to know, because most companies, certainly international organizations such as Estee Lauder, don't have necessarily all of their companies on SAP or on a single instance of SAP. So we can integrate across instances, or we can also have participants in the in-house bank that are not on an SAP instance. So it gives you flexibility to deal with acquisitions and the like. So then when we look at the structure and we take that and turn that into emphasis on process, then we really have as our primary and one of the first and I think one of the largest value add propositions for the in-house banking solution is intercompany invoice settlement. Bart, can you talk to this a little bit?
Yeah, no, definitely, Peter. I mean, again, I'm going to reiterate obviously some of the things you highlighted before, but this is a very important feature, if you will, from the overall setup, if you will, the deploy or how we deployed it at Estee Lauder. So really what you see here on this picture, again, as said, all of those entities will have an account type with the in-house bank. Mostly that will be what's called a standard account, a regular current account, if you will, in its functional currency. And that account will be, it will be debited and credited for any possible flows that will happen. If an entity collects cash on its bank account and that bank account gets swept to the ITC, ultimately those funds will be credited then to its in-house bank account. And it's in that in-house bank account that that entity will keep its excess cash, its funds. And those funds, again, this is managed like a plain bank account, will be interest bearing. So we apply an interest calculation. From our perspective, we've opted to apply a monthly interest rate on balances held on that current account. And we capitalize those interests at month end on the in-house bank account. But different options exist, obviously, and are available. As you've highlighted previously, Peter, I mean, again, besides what we call a standard account, some entities also can have what we call gross in or gross out accounts, because in my previous example, if there's a settlement happening, if you will, well, in the example I gave was an excess cash position coming in on a bank and then pooled or ZBA to the Treasury Center. But if there are intercompany settlements happening between those entities, even no bank gets involved. That really gets reflected via the netting process. And each entity's bank or ST&D account or standard current account is debited and credited. There's no bank account that comes into play here. But that's not always the case. So in some jurisdictions, there are limitations that entities cannot virtually settle funds. So without any true payment or true collection. And then we have created a different type of solution or a different type of account, a gross in, a gross out account, what we call, through which then those entities can make a payment to the Treasury Center, which funds then will be credited to their gross in accounts, or can receive funds from the Treasury Center, which will then be debited against their gross out account. Again, the concept is then that our gross in and gross out accounts are effectively netted out to zero by settling cash, by settling their netting position in cash. But again, it's a means through which we can leverage, let's say, the in-house bank also for entities that cannot settle virtually.
So Bart, if I push forward to this next slide, you covered a lot of this material, but I'm also being conscious of time here. We're at about 45 minutes. Sure. So you covered most of this, that it's mandated that they participate in the in-house bank, fully integrated with the SAP in-house cash solution instead of the external solution, and that you're processing the payables and receivables cashless or book settlement wherever possible. Cash when necessary, but book settlement otherwise. And the majority of your relationships are book settled, right, as opposed to cash settled. But where necessary, you're able to take advantage of the book settlement and then cash settle those entities that aren't allowed to participate. And this is a big topic that we have a lot of customers and prospects that look at these solutions ask about, that they don't think there's an opportunity to bring those types of companies in, but we have found that we can build these solutions that allow them to fully automate with the integration clearing of the invoices, but then we just cash settle them, so you still get a lot of efficiencies out of that model. The other thing I think that was important that I don't think you really touched on is that this is a pull-driven, AR-driven solution that because you transfer a lot of the relationships to the ITC as far as the open invoices, it's the ITC that's going out and reaching and grabbing and pulling the money from all the affiliates. Typically, we see these solutions as being AP-driven, and so I think that is a unique aspect of your solution that that is particularly interesting here. And then we have the kind of scope and sizing. There's 90 entities, 25 different currencies being processed there. 200,000 invoices each month and about 650 million in settlements on a monthly basis. So very substantial, very broad, very comprehensive intercompany netting solution, including both international, U.S. processes and entities. So I think that's a very good overview of what you have deployed. So I'm going to move forward here since we have the again, running tight on time, I want to leave a couple minutes for questions. So on the payments on behalf side, you had mentioned before about foreign currency payments, that we process foreign currency payments through the in-house bank solution, POBO, so POBO being payments on behalf of, and participants participate in their in-house bank through their current account, through their virtual account. They send those payment requests to their virtual account. It goes to the in-house bank that they participate in, and then through automated processing, the system routes the payment appropriately. If it's an external payment in the currency where the U.S. in-house bank, for example, they only manage U.S. dollars, then it would route to the external bank and go to the appropriate payment method for the most efficient or optimized processing from a cost and a time perspective. And if it's a foreign currency payment or a cross-border payment, then it can be sent over to the other in-house bank or through the in-house banks from ELI to ELII to ITC. And ITC holds the majority of foreign or all foreign currency accounts for processing. So then that gets routed, or the payment gets routed to the external entity that provides the greatest the greatest optimization of execution, depending on where you're sending it, what payment method, what payment type. So is there anything you want to add on this part, Bart?
Yeah, maybe just highlighting, I mean, maybe an important characteristic here. When we're talking POBO, the thing is, if an entity executes their POBO payments, it's actually, for them, it's reflected on their in-house bank account, and then it's done. And that's where their reconciliation takes place. There's no bank account on their side that gets involved. And those payments get moved and are transitioned then to the Treasury Center, whom from then on will execute those payments to the bank and will reconcile its bank account, if you will. And so it's two different things. One, that process gets kickstarted for a participating entity, really. It's really simple. I mean, it's paid and it's directly, immediately reflected on its in-house bank account in its functional currency. And it's translated at an exchange rate, if you will, that we use within our group, if you will, on a monthly basis.
Yeah, that's a great point, that essentially they get a bank statement back from their virtual account that is the same as them processing at the external bank, but they have no connection to the external bank. That external bank account is owned by the in-house bank. They process and reconcile the external accounts, and the in-house participants just get their own statements from their virtual accounts. That's a great point. Okay, so then, and also we identified that you have 25 managed currencies, but the system is set up to be able to accommodate payments in up to 103 additional currencies. I know it's not likely that a lot of those would get used, but you utilize the WorldLink process at WorldLink checks, and that really allows you to really send any foreign currency to Citibank for them to process through WorldLink. And so you can execute through the in-house bank even though you don't manage that currency externally. So I think that's a great robustness of flexibility for your smaller volume currencies where it doesn't make sense to manage or hold an account in that currency.
Correct.
Great.
Yeah.
So then on the cash pooling, one of the things that we've talked about a few times is that you have these accounts around the globe in a variety of different currencies. You have pooling structures where a number of those accounts are tied together in a hierarchy so that the funds concentrate to an external account owned by the in-house bank or one of the in-house banks. And that allows you through ZBA, zero balancing, or TBA, target balancing, where you can set a balance other than zero, to facilitate fundings and cash concentration into those pools to centralize those funds at the in-house bank, where you have much greater control and ability to leverage using those funds, either to pay down debt or to borrow, or to pay down debt or to invest and get a better return, and give you much more control centrally, visibility over your risk management and over your liquidity management aspects. Additionally, there are accounts that are not tied directly to those TBA and ZBA structures where you can fund them ad hoc. You can send from the in-house bank, send them funds, or the participant can send money to the in-house bank and put it on essentially on account, on their virtual account. So with those, we can facilitate that automatically through the in-house bank, through reading of the electronic bank statement, or through facilitating that through the in-house bank. So is there anything you want to add to this aspect, Bart?
I think the key takeaway here is that we, as many others probably will do same, we try to keep these local bank balances as low as possible. And we're doing that through a mix of solutions. It can be a zero balancing, an automated zero balancing solution, but it can be also a manual pooling structure, if you will, where entities which hold excess cash are required, let's say, to send that cash to the ITC's bank account for crediting to their in-house current account. So it's a mix of solutions across the globe.
Yeah, and I think that one of the things that we see is that a lot of companies, when they establish a structure like this, a lot of times they won't automate the intercompany or cross-company cash poolings, because the administrative aspect of tracking those ZBAs every day and booking them manually is very tedious. So they'll end up making those manual push, and they'll leave more funds sitting idly out at those affiliate accounts. With this kind of solution, you automate it through those ZBA structures, and the electronic bank statement can automatically be recognized, those transactions, and book them automatically to the in-house bank. So extremely efficient structure processing, which really takes no human intervention, right? So a great overall process. Terrific. So then that really is the summary of the processes. And again, there's lots of other processes in there. Those are the primary large processes. But I think, Bart, if you could really summarize and wrap up on benefits, and then we can hopefully get into at least a couple minutes of questions.
Yeah. I'm conscious of time. Just want to keep some questions time for questions at the very end. So the summary of benefits, really, I think, improving cash flow transparency and visibility. That's an obvious one, because we have all of these accounts now reporting into our centralized treasury system, or SAP system. The intercompany positions settlements, again, as highlighted before, most of it is virtually settled. And if it can be virtually settled, it can be connected to the in-house bank account nonetheless. So that's a big win. Payment factory, we just touched upon that. That's now fully integrated, ties in with that other bullet point, enabling STP process. Very important from us is that we can do away with some of these standalone bank portals, but having that process directly initiated from within SAP. Ties in with the next bullet point, obviously, that we're now using that standardized payment gateway through SWIFT. The cost, obviously, with maintaining all of these bank portals, that's also goes away. The duplicate bank statement that needs to be fed into those bank portals in SAP, that goes away. There are obviously also incremental financial benefits, as always, with a project like this that you can calculate. We need to take into account, obviously, that we already had an in-house bank deployed at the International Treasury Center, the least. But there are obviously reduced fees and labor costs that you can pull out of this exercise. So, all in all, I think this is a great summary of the benefits that we saw when implementing this project.
Terrific. Thank you for that summary. Great. So it looks like we have about 4 minutes left or so. Christine, did we get any questions coming in?
Yep, we have a few questions. So I guess, Bart, this one's for you. What kind of challenges did you face with implementing the in-house bank and in-house cash solution? Maybe going into
well, always challenges, obviously, with a project like this. I think it's fair to say that looking at the deployment of a solution like this is a global deployment. So we're involving many stakeholders here. It's obviously not all about Treasury, but it's all about the different subsidiaries globally. IT is a big part of it, obviously. You have AP, accounts receivable from a reconciliation perspective. So many different stakeholders, which all have to be on the same page. So that's, I would say that's definitely a challenge.
Did you have a secret for winning them over, or a special tip?
Your charismatic ways, Bart.
Yeah, exactly. There you go.
Persuasiveness.
Patience.
Patience is a good one. That's a good piece of advice, I'm sure. Yeah. Excellent.
Yeah.
So I think that is a very common. Just to supplement that is very common, right? There's so many different stakeholders across so many different areas, typically reporting up to different management teams. And so getting that buy-in so that, one, you can get all the requirements you need, two, that you can come up with a solution that people buy into, so when you try and deploy it, they're comfortable with it, and that you get them persuaded that this is going to be successful and add value to them. You really need to get that buy-in. You need strong executive leadership, strong executive support, to ensure that you get the buy-in across teams, because it can be very challenging.
Yeah.
And to be honest, some teams maybe lose out and some teams win more, right? Some might take on some processes, or someone might lose some ownership of their little fiefdom that they were used to having and owning, and now the lines shift a little bit. And so there's certainly implications there for end users, managers, departments. So it's very important that you get that buy-in early on and engage them throughout the duration of the project.
No, yeah, it's certainly true. I mean, what we've laid out here are, I mean, we're talking about benefits and key wins, if you will, if you implement these type of structures. But we're talking from a treasury perspective. But all of those participants don't look at it that way necessarily. And so they all need to be persuaded, if you will, that these are indeed benefits, even for them, and maybe also on an overall company perspective. So that's important.
Great.
Completely.
Can we squeeze one more in there, maybe?
We can squeeze one more, yeah. So why does Estee Lauder drive most of their intercompany settlement from the accounts receivable side? So, Peter, you mentioned how unusual that is, I guess. And so maybe going a little bit more into detail about that.
Yeah, I think, Bart, you had said that really the primary driver was about moving that to ITC, the invoices, right?
Yeah. The ITC plays a pivotal role, if you will, in settling these intercompany invoices. Intercompany invoices usually within our organization are sent from a manufacturing hub, if you will, to a sales affiliate. And really those invoices are transferred or assigned to the ITC to settle. So really we hold all of these intercompany receivables, and hence we settle them, we pull them towards us. And that's really the thought behind it.
Okay.
Yeah, it's definitely atypical, though. Most entities, most organizations do pay driven, because the company giving up the cash or the ownership, the value, the asset is the one usually deciding that, yes, I approve, I did get the product you gave me or sold me or whatever else, even if it's intercompany, but they usually use it on the paying side as the driver. So I think we're probably done with time. I do see on the last slide that we wanted to emphasize that we have lots of videos of other webinars. Bart, I want to thank you very much for the insight that you brought to the table. A lot of great information there. The slide will be available for download as well. And again, there are lots of other webinars out there. We did a similar case study with Microsoft a few weeks ago. We had a panel discussion as well. So I think there's a lot, especially in the in-house banking space, but across the treasury space. So if you go to our website, you can get access. And of course, we would love to speak with you and discuss solutions with you. If there's anything we can do for anyone that's attending here, please feel free to reach out to me directly or to our contact at Serrala email address there. And greatly appreciate everyone's participation. And again, once again, thank you, Bart. Thank you, Christine, for hosting and keeping us on track there.
Okay. Well, thank you, everybody, and join us for our future webinar series. Thank you very much, Bart, for joining us. Have a good day.
Thank you, everyone. Have a great day.
Stay safe. Bye.
Yeah, stay safe, right.